It's true. Across the globe, women aren't as prosperous as men. Gender inequality is a pressing moral issue, but we forget it has massive economic implications. If you were to put all of the women who don't have access to formal financial services in one place, they would make up the third largest country in the world. That means an entire population without bank accounts, credit cards, or other tools you and I likely benefit from daily. Prosperity for women starts with inclusive policies, products, and people around the globe, and the investment to make it happen. Welcome to the Making Finance Work for Women podcast. My name is Sonia Kelly, and I lead Women's World Banking's proprietary research division. Join me as I speak with changemakers around the globe to deconstruct the social and economic exclusion women face. We'll discover new evidence together and drive action to accelerate women's economic empowerment. Because a leg up isn't a handout, it's a global game changer. Indeed. Welcome and thank you so much for tuning in to the Making Finance Work for Women podcast, now streaming on YouTube and available wherever you get your podcasts. If you're listening on YouTube, you'll be able to find additional insights and resources linked in the description of the video below. I'm the host of the show, Sonia Kelly. I'm also the global head of the Women's World Banking Institute. And before we get started on our topic today, I'd like to give a special shout out to the sponsor of the Making Finance Work for Women podcast, which is Ernst & Young LLP. EY is a global leader working across assurance, consulting, law, strategy, tax, and transactions. EY teams ask better questions to find new answers for the complex issues facing our world today. You can visit their website at ey.com to explore their latest insights and services. Now let's jump into the show. Today we're going to be talking about an innovative approach to alternative credit scoring. And that's two innovative things. We're already talking about alternative credit scoring, and then we're talking about a new approach, and I'll explain all of this, I promise. Now imagine you're someone who doesn't have a credit score. Or you're someone whose credit score doesn't really reflect just how creditworthy you actually are. If you're in that situation, how might you get a loan? And that's where alternative data paired with AI comes in. Now, myself, I can think about my own financial transactions. Things that I do, like paying my mobile phone bill or paying my utilities, is alternative data in many places. Think of it. I don't pay for my electricity. You can see lights around me if you're watching on YouTube. I don't pay for my electricity in advance. Like I don't prepay for that. The electric company lets me use electricity, and then they send me a bill at the end of the month for how much I used. They're basically giving me a loan. That data on my repayment of my electricity bill should show up in an assessment of my creditworthiness, but it doesn't in most places in the world. Now let's think about other data. Like if I were an entrepreneur and I regularly paid $100 per month to my suppliers and then regularly took in $200 per month from my customers, okay, that would be a really good profit margin for me. A bank should know that my business has $100 per month that I could be using to pay off my loan. This is a really cool topic to me because it takes us beyond traditional financial models and incumbent solutions to assessing creditworthiness. But I told you this is like one level above in terms of innovation, so we're going to take this even further. My own creditworthiness isn't just determined by my own behavior or my own business. We learned during COVID that there are systemic issues that affect all businesses together. So in COVID, many businesses in a particular area were forced to shut down. And in a time of increased climate risk, for example, we can start to think about what if lenders could see a climate shock coming and adjust their client's repayment plan before it hits? Or more fundamentally, can a credit score be compassionate? Can it be tailored to the specific vulnerabilities that people are facing? And can it be responsive to their needs? This is really important for climate because globally, 3 out of 4 women who don't have adequate access to finance live in a climate vulnerable region. I often try to offer a story of what this looks like in the lives of an individual person. I want to introduce you to a woman in India, Apurva. Women's World Banking has talked with her and worked with her extensively. I'll link her story in the YouTube video comments below. Now, Apurva is an entrepreneur who, with her husband, started a hotel with a loan. When we talked with her, she was so proud of the mini empire she had built with her hotel. One day, though, her business was wiped out because of a cyclone. She told us that after the cyclone, there were only 4 walls left of her beautiful hotel. Apurva then had to get an emergency loan to cover the cost of rebuilding. And she does this as well, not just this one time because of the cyclone, but most monsoon seasons, she has repairs that she has to do on her hotel. This means that she has a loan she's carrying for her business, like the general loan she used to start her business. And then she also has the emergency credit to repay. If there were a way for her lender to be aware of Apurva's climate vulnerability, the credit she receives could better fit her ability to repay. And imagine a world in which during monsoon season, Apurva gets relief from paying that loan she used to start her business, and instead is like paying more upfront on her loan. And then after the monsoon happens, like once things get better for her, alternative data like climate risk data can get us there. So with that explanation, I'd love to introduce our guest, who's actually a friend of mine. Puneet is a co-founder at Kaleidofin. Kaleidofin is dedicated to delivering financial services at scale. Puneet believes that the power of technology can be harnessed to amplify the role that financial services can play in the lives of customers. Prior to setting up Kaleidofin, Puneet co-founded Devara Trust and Northern Arc Capital. Puneet also serves as the director of the investment committee at the incubation cell at IIT Madras, and he began his career at ICICI Bank. And Women's World Banking is proud to call Puneet's company Kaleidofin a valued network member. They've been a network member now for 6 years, since 2019, and I'm so pleased that he's joined our show. Welcome, Puneet.
Hi, Sonia. It's a pleasure to be here. Thank you so much for having me. And as kind of you were introducing our work, and I would say that it's just such an amazing thing to be a part of the network that you've created. There are very, very few organizations in the world who are thinking about access to finance for women. And every time I've seen your podcast, just the intro, the focus on the fact that how many women are excluded, and the fact that they would be like the third largest country in the world if you were to put them together, it's just so hard hitting. And we are not kind of sitting in the post World War II era. We are in 2025, and it just almost feels criminal that we are still at that stage. Thank you so much for having me here, and hopefully, we'll have a conversation where we talk a little bit about our work to say that how can some of this be changed.
The pleasure's all mine, Puneet, and I really hope my podcast producer was listening to that testimonial because it was so kind, and clearly you're a person who listens to the podcast too, which is wonderful. When our guests come on, I love to start by asking what your origin story is. Like what brought you to the Making Finance Work for Women movement?
So, Sonia, for me, it will be a very long story. I'll try to keep it as brief as possible. I began my career with ICICI Bank, set up a team which was trying to solve the challenges of access to microfinancial services. And 2001 is already seems very different from where we are sitting in 2025. Most of the
That
microfinance,
was over 2 decades ago. That's so
yes,
wild.
yes, it is. It has been a long time. So clearly, at that point, most of the entities in India that were engaging in microfinance were trusts and societies. Their portfolios were small. A lot of this was a grant-making structure. um, that effectively was looking at using grant to be able to create reliable access to financial services. So I began my career really there, but the thought was that it has to be a sustainable business model. We can't be relying on grant if we have to solve the problems of billions of people as opposed to just a very tiny sliver of population. Um, and it wasn't really also obvious to us that why would there be a need for grant to do this, because frankly banks are in the business of lending, and why would a bank not try to lend to a very very large segment of population, and especially if you are in a developing country like India. 85% of the population is self-employed. Um, this is a group of people who are living in the unorganized sector. The top 15% of the country, I would say, is overbanked, where everybody's trying to reach out to them. And it just makes complete business sense to be able to reach out financial services to the informal sector. So I really began there, worked in ICICI Bank for the next 7 years, tried to see how bank could become an important participant in the area of microfinance. At some stage, got stuck with challenges like what you talked about, Apoorva's challenges, which was to say that access to credit cannot be everything. We do need customers to get access to many financial services. And with this, after having learned from some of the network members of Women's World Banking, I remember my visit to WWB Kali, where we saw how a branch based infrastructure could be created to offer multiple financial services to customers.
Hmm.
And that really became the motivation for me to start to think about moving on from ICICI Bank. 2006 end, I decided to take the plunge and move to the city of Chennai to set up my first entrepreneur venture, which was to set up Dwara KGFS and Northern Arc Capital. And Dwara KGFS was modeled very much on the designs of what Women's World Banking Kali was doing. Try to see how we can weave products beyond just credit, and start to do in a variety of ways some kind of financial planning for each of our customers,
Hmm.
and then recommend to them the kind of products that would make their lives better, that would reduce vulnerability for the household. Built those businesses from 2007 till about 2017. At some stage, started to see that while much had happened, joint liability group models was still the largest way of doing this in India. Uh, and our concern there was that how can access to credit be dependent on my ability to form groups? In fact, if you ask me to today borrow from a bank, but I have to get four other people to co-guarantee me, I would basically tell the bank to say, bye, I don't want to work with you.
Well, and it's not just like
And
finding four other people, it's also the time it takes to do the meetings together, and like it's really resource
yes,
intensive to
it
engage
is.
with the group. Yeah.
It is. And in any case, my ability to borrow becomes contingent on the ability of the most vulnerable person in the group to be able to repay, and that's not necessarily the best design. So we started to think about, with new data getting generated now, is there a way for us to start to use data of the customer to be able to underwrite customers? So move away from process-based microcredit, which is much more around building groups, or process-based credit, where you are appraising the value of the collateral and giving the loan on the basis of collateral value as opposed to underwriting the customer. We started to feel that there was a model out there with which we could create a very strong credit scoring model. So with that, I moved on from my previous startup, which was Northern Arc Capital and Dwara KGFS, and decided to set up Kaleidofin with Sucharita, who was also co-founder with me at the Northern Arc Group. And yeah, so that's basically been my long story of how we ended up here. So I moved from traditional bank to an NBFC trying to look at innovative models to now a data science company which is thinking about the power of data to be able to create underwriting models. So it's been a bit of a change in my life ever since.
Yeah, and for our listeners, NBFC is non-bank financial company, and it's a license in India. I love I love the story of what you're doing because it solves a major problem that microfinance has, not just group lending, but when we look at the data of more traditional microfinance from like 20 years ago, people were engaging in large groups, so like groups of like 10 or more. And then as their loan size got bigger, the groups were able to get smaller. And they were with people who they'd been borrowing with for a while. But then there was like this ceiling that they ran up against. And it was really hard to transition people from groups to individual loans, in part because of a lack of data. And so your company does the customer due diligence on the kinds of people who need an individual loan, but might not otherwise get that from a financial institution. I like to think of Kaleidofin as kind of taking the guesswork out of lending, and you're known for using data to drive inclusion. So I wonder if you can tell me what kinds of data you're using in your work at Kaleidofin.
Yeah. So the thing about data is that you will always have some data, but as my data scientists will tell me, the data that is truly required is not available. Right? So there is always this thing about people talking about the fact that, but there is no good data. And so as I kind of talk about what is the kind of data that we use, I just wanted to actually start by talking a little about data quality because most people who I speak to are always bothered about, but where is good data out there? So I would basically say two things here. One, that as promoters, as co-founders, as entrepreneurs, I actually think that not the data not being completely available is important because if all of the data was available to everybody else, there isn't really an economic model for anybody to be able to build a business. Then a bank could come in and everybody else could come in. And I think as entrepreneurs, we thrive in an environment where there is uncertainty, there is lack of data, and that's basically where the entrepreneurability starts to come into play. The second thing is that uh, there is nothing like perfect data. But what is really important is that are we better off kind of building on what we have right now? And having said that, I don't want to kind of sound like I'm already making excuses for the fact that data is very poor. Data is actually very rich, and I'm going to talk about that as I start talking about sourcing of data here. So, Sonia, coming really to your question around what kind of data that we use, I think at the first level, we start with traditional data, which is transactions data. What kind of transactions data is available for each customer? That's number one. We supplement it with credit bureau data if wherever credit bureaus are available. Because what a credit bureau data does for us is it not only gives us the experience of the organization that is lending, but also other people who have lent, who are lending to this customer. So that gives you a much more granular information about the customer and their borrowings. Then loan application data of the customer becomes really important, which gives you the purpose of the purpose of the loan, the income of the customer, the demographics of the customer, and those become really important. Uh, and then we go to immediate data points, which are verifiable data points, which, for instance, includes weather data, precipitation data, temperature data, anything to do with data that can impact the customer. So, if you are in a rural geography, a lot of businesses automatically become dependent on agri output, and therefore anything that you can use to be able to build out models related to agri become very important. So for that, we end up adding to that two more pieces of information. One is any arrivals of uh, grains, fruits, vegetables in the nearby markets, which tells us the yield data, and we also add the price data to this. So it's technically possible that because of low rainfall, yield fell, but prices increased, and therefore you were not worse off. You could actually be better off in some cases. Uh, so this is again all verifiable data. Then what we do is we add to this information around loan officers. And I'll tell you why this is important. So a lot of the information is still going to be declared information by the customer. What
Mm,
is my income? What is my expenditure? How much do I spend on emergencies? And the loan officer or the field officer, whatever you call this individual who's collecting data, their interpretation becomes very critical here. So you will find that there are loan officers who are extremely conservative. So they always put the income to be lower and
Huh.
expenses to be higher. And there are loan officers who are a little bit more relaxed and they will take the income levels to be higher, expenditure levels to be lower. Now, if two different loan officers met customers who were exactly the same, you might get completely different data in your databases.
Wow.
However, However, directionally, this is very interesting. So, if a conservative loan officer had appraised 10 customers, and if they are saying that one has more income than the other, then that's directionally accurate, right? So, if you look at your entire database and add the data about loan officers, you can still start to get a lot of information here about what is really the rank order of customers. And then what we do to this is we take the data and convert it into features. So, what is the max loan installment ever serviced by the customer? What is the max number of loans that have been taken by a customer at any point of time? Do you show a pattern of default 4 weeks before Christmas every year, and do you repay right after Christmas? Because then that might just be a strategic default to say, I'm not getting a loan, but I do want to add stock for Christmas. Or are you a customer who keeps distance between two loans, or are you a customer who's just continuously borrowing? Now, a lot of the data that we get from loan application forms, different kinds of loans that have been taken, starts to actually give you a lot of this information. And then the last thing that we add is any kind of default event behavior. So, were there floods in an area? Were there droughts in an area? Did a politician come and announce that there are going to be loan waivers? In India, we had a situation of demonetization where we outlawed our own currency, and there was a huge shock to the markets.
I remember
COVID
that.
was one.
I was there that week actually traveling and I couldn't get any money. Like I had no way to pay for anything. Yeah,
Yes,
wild. Yeah.
and
Systemic shocks. Yeah.
then we had COVID data. Now, in any of these shock events, there could be customers who do not default at all, customers who default and come back in 1 month's time, customers who default and come back only when they get a new loan. Now, you can still create a wonderful rank order out of them. And the
Mm.
moment you do this, you have used the transaction data to be able to build out a beautiful behavioral model out of this. So that, in a nutshell, is the kind of data that we use, Sonia, and this is what eventually feeds into data models. I'm not even talked about alternate data right now. I'm still not talking about who are you calling, how many times are you calling. I would still say that a lot of the alternate data, especially on smartphone usage, is we still need to learn a lot more about whether they are predictive or not. But these traditional data that I'm talking about right now, that itself is so huge and so powerful that there is a lot that can be done. And of course, we keep supplementing it with any alternate data that we can find.
Well, you started off saying like it's actually really interesting that there's not broad availability of data. It creates space for a business model for a company that's solely focused on data and data analysis. I would go even further to say it's always going to be a guessing game to know whether somebody is
Yes.
creditworthiness or creditworthy because you're always going to be just trying to predict the future. You're like a fortune teller and trying to say like, oh, this person in the future will repay their loan or this person will not repay their loan. And I love that you're thinking creatively about how to solve that fortune telling challenge. We recently worked together, Women's World Banking and Kaleidofin, to use an AI based climate risk model to predict creditworthiness. You talked about weather data, which I find
Yeah.
weather data so fascinating. It is publicly available. You can use it to create models and make predictions. Um, I'm just looking back at our data here and using weather data to try to predict when somebody would have a hard time repaying their loan. We were able to achieve an AUC, which is an accuracy rating of
Mhm.
82%. And by comparison,
Wow.
without using the weather data, the AUC was 76%. Um, I call this compassionate credit scoring because we're trying to predict when somebody will have a really hard time paying their loan and might default, which has ripple effects on their borrowing in the future. Um,
Yeah.
like Was there anything that surprised you about the results using that climate data, and how are you thinking about that going forward as a lens through which to evaluate creditworthiness?
Yeah, no surprises, Sonia. In fact, the thing is that we are a company which is kind of focused on data science, and I think for me, given that I started my career with standard lending in banks and then in non-bank financial institutions, it took me a while to kind of completely understand what is the power of data, what is the power of building these models, and how, as human beings, we can actually get very stuck because it's very hard for us to be able to visualize more than a few variables at a time. I think when it comes to some kind of a simplistic understanding, we are very good, but when you have 25, 30, 40 variables, and there are some which are negative, but there are some which can be counterbalanced, it becomes really hard. And uh, to my mind, Sonia, the thing about climate and weather is that, I think you gave the example of Apurva in the introduction. The risk is it, the risk starts to look so huge that it can actually just completely take away financing from that segment. So I
Mm,
would still say that in the Indian context, it's easier to give money to women who are, let's say, borrowing for enterprises than to give money to women who want to, let's say, make an improvement to their farmland for which they need a loan for 3 years. Right?
mm,
The challenge is that with climate risks becoming more and more frequent, if you have a 3 year loan, you know that some event will hit you. Even if it's not a major shock, a minor one will definitely hit you in every 3 years now. So the thing is that uh, when you start to look at risk without data, the perceptions of risk take over, and perceptions of risk oftentimes are far worse than the risk itself. What models that we are able to build today is able to actually do is to be able to bring it closer and closer to reality. That's number one. The second thing that we are able to do is we're able to assess what kind of a risk definitely needs insurance and what kind of a risk are we able to live with.
mm,
And we are able to also identify in many cases a situation where we are able to create hedges as we are offering the product itself to be able to make sure that we are able to work with this. Just because we've thought about whether we've thought about some of these issues which are possible, it actually can create a possibility of product design that makes this better. So, so I would say that knowing some of this data well and not just at a perception level allows actually even for product development and product design, which makes it much, much, much better for customers.
mm.
So yeah,
And now, a word from our sponsor. EY applauds Women's World Banking's 45-year legacy empowering women through financial inclusion. Together, we have a common vision to build a better financial services industry, one that is stronger, fairer, and more sustainable. Find out more on ey.com. Well, and that leaves me. So, first of all, I think it's hilarious that I said, "What surprises you?" And you, as a data scientist, said, "No surprises," which I think speaks to how much of an expert you are. But to me, there that was a huge surprise. But you've already started talking about like advising financial service providers on their products, thinking about product mix. And so I wonder if you can say a little bit more about um, how you advise financial institutions so that the data that you're giving them, let's say on climate risk, like you give them data on climate risk, you say this customer is going to have a really hard time repaying during monsoon season these two particular months this year. How do you keep a financial institution from saying back to you, okay, great, we're not going to lend to them? How do you encourage them to increase financial inclusion instead of to say no? That must be a challenge.
yeah. So Sonia, I think this is where at the core of the model comes into picture. So at the core of the model, we are looking at two different things. One is what is the design element that can actually reduce the vulnerability of the customer during those 2 months, for instance, right? Is there a way in which something can be insured so that we don't have those 2 months of vulnerability? That is the ideal use case.
Mm,
And then there is a second part, which is to say that let's say we are not able to mitigate the risk for the customer and the customer ends up taking the risk completely. Uh, Now, in this particular situation, what the model is doing is it is looking at the customer to say, if you defaulted on these two installments, are you going to come back and repay these loans based on my previous data experience with you? Right? Now, this becomes very powerful. So, there could be some customers in our model where we know that even in a risk event will not default at all. They will be the top of the client list and they will be the customer that everybody wants to go after. But
mm,
what we are able to prove to our partners who are using our data models is that there are customers who might get hit with a shock, but they will come back and they are not really the best customers, but they are really good. They have a huge willingness to pay you back. And in most of these customer segments, especially in the includes in the informal sector customers, what we find is that there is a need to be able to work with customers even knowing about their vulnerabilities, right? So if you know that a customer is able to come back, then it makes for a very, very strong customer in the long run. So that's
mm,
largely what we're trying to do. What we've not been very successful is to be able to create product designs where we can skip payments. Um, Unfortunately, with various central banks and regulators, any kind of skipping payments which is not predefined and is trigger based is treated as evergreen. Um,
okay. So
and
like COVID was a
that
bit of an exception. I remember in
COVID
COVID
was
there
an
was a
exception.
moratorium. Okay.
Yes.
Mm,
But it was given to people irrespective, right? It was basically not a treatment given to 10% of the households. It was basically given to 100% of the households.
mm,
So the challenge with the regulator is always going to be, are you just evergreening? Are you now not showing them as defaults, but they should have been actual defaults? And one can actually relate to what the regulator is saying here. We've tried it in a different fashion as well, Sonia. One of the things that we've tried in the past is to say that let's get households to be able to build a small buffer which is equivalent to 2 to 3 months of their expenses. If people could get to a savings balance at that level, then some of these challenges don't exist in the lives of the customer at all. But again, we realize that that could be very expensive for the customer.
mm.
Um, 2 to 3 months of expenses to be kept in a savings bank account at a very low interest while your borrowing rates are very high, uh, oftentimes could be criminal when it comes to customers. So it's a little bit of a tightrope walk there. But my sense is that through the model, we have an ability to be able to talk about what will happen if the customer does get hit with the risk and what would be their response and will it translate into an actual loss or just a delayed payment. And that itself is enough for most entities to go forward as opposed to reject customers.
Mm. And it sounds like there's a lot more work to do here. Like the
There is,
space
there
that you're
indeed is.
working in,
Product
there's so much that could change and improve and be dynamic in solving challenges.
On a product design, absolutely, Sonia. But I would also add here that one of the big things that we've been able to do with our data science models is we've been able to reject much fewer customers as a result of a model.
Mm,
So our average rejection rate for the model is now down to around 13%.
that's
Um,
amazing.
when it
13,
comes
like
to
1-3.
1 3,
Wow.
so we are able to actually lend to most customers, and this is in line with the average delinquency. If you look at microfinance delinquencies in India, at some stage India had very low delinquencies around 1%. Now we are starting to see those delinquencies on an average jump up to around 3.5%. So we are still eliminating 13 for 3.5. Uh, so we are always at it. One of the things that we've also worked with Women's World Banking was an analysis of who are the customers that we are rejecting? And is there a bias? Can we correct for algorithmic bias here? And bias is easy to get into these models because if you're training models on the basis of who you're accepting, And if you're accepting a very small sliver of customers, then the model automatically learns that you should be rejecting who was automatically by default rejected. Uh,
Mm-hmm.
so that's one. To give you a comparison today, if an entity was originally sanctioning the loans to 100 customers, after using Chi-Score, they are today sanctioning
And the
170.
chi-score is like Kaleidofin's proprietary scoring model, right?
Yes, that's our scoring model is called Chi-Score. So after you start to use Chi-Score, you're now giving loans to 173 customers. So it's a 73% improvement in your overall client uptake. Another thing that I would add here for the purposes of what the model has been able to do is our delinquency rates measured as 90 days overdue have continued to remain lower than what it was. So not only is the throughput gone up by 73%, our loss rates, if our partners use Score on a month-on-month cohort of origination. So if I were to look at the peak delinquency in any cohort, and the cohort being defined as the month in which a loan was given, our delinquency has never crossed 3%, including in high risk events. India is, by the way, right now going through a very high risk event where 90 days overdue for most organizations is between 8% to 13%. We have
Mm-hmm.
never crossed 3. Compared to that, when people did not use Score, the delinquency rates measured in the same cohorts is in the range of 8 to 12%. So that's basically the wedge that we've been able to bring in terms of the use of data. So clearly, there is a strong use case both from reducing cost of credit as well as reducing cost of customer acquisition when it comes to the use of database models.
And so important these days, actually, because that measure of credit portfolio quality in India is something that we're also seeing in Nigeria, in Indonesia, in Vietnam, in Cambodia, in a lot of other markets right now for various reasons. There's actually not one reason we can point to, like COVID, but
Hmm, hmm.
for a lot of different reasons. And so I want to ask you just one more a rapid response question to
Sure.
close us out. I was just struck in our partnership on both the algorithmic bias piece and on the climate piece
Hmm,
um,
hmm.
of these are kind of low hanging fruit opportunities. It's not like getting when we talk about alternative data, sometimes we talk about crazy things like getting a customer's contact information from their phone. We're talking instead about like using existing data or
Yeah.
getting low cost, non sensitive data. And so I wonder if this signals a new standard for affordable, ethical, and scalable alternative data use in credit scoring. So, rapid response question: what would your advice be to financial institutions in other parts of the world that haven't yet explored this? Like, how can they get started?
So, Sonia, very quickly, I would say that from where we are seeing it at our vantage point, I think this is there's a great opportunity for most people across the world to be able to do this. Some of this data exists everywhere. We just started working in Bangladesh, where there's no credit bureau, and we've got one signed partner who's working with us on trade models. BRAC is looking at our model right now. We're doing a proof of concept with them, and it's looking good. We've taken this to East Africa, where again trade bureaus are not as strong. We started off in Kenya already as we're working there, and we are actually finding that the data is in each of these places different from what is available. But Kenya, for instance, example, has a wealth of information on mobile money usage, which I would say is so fabulous. And so we are learning a lot in every market that we're going to. I see it as a great opportunity overall.
Thanks,
Thanks.
Puneet. I see you like a chef. Like you've got lots of raw data ingredients and you have kind of a special recipe putting them together. And I hope there are other chefs that come into the space. But in the meantime, congrats on what you're doing. And thank you so much for joining us on the podcast.
No, no, absolute pleasure, Sonia. Thank you so much for having me. It's always been a delight speaking to you, and I enjoyed my conversation today as well.
Thanks, Puneet. Well, I have a lot of notes from my conversation. I always like to go over my notes so that you hear what I was learning, and maybe you have some notes you can compare to yourself. First of all, Puneet started by saying it has to be a business model. Like there has to be a business here. It's not just a charitable activity. It used to be like decades ago, microfinance was charity, but now we're talking about a full suite of financial services, and we're talking about private sector institutions being able to make money here. And so that's one message that I keep coming back to is making finance work for women is not just a social goal, even though there are social benefits. It's a financial goal. There's a business case here. He gave the example of in India, 85% of people are self-employed. That's a huge market and a big market for whom there's not a lot of data. And that's a big opportunity. That's an opportunity that's reflected in other markets as well. Puneet mentioned Kenya and Bangladesh is also true in Cambodia and Vietnam and Indonesia and Nigeria. He talked about at the beginning of his career, actually focusing on financial planning for low income customers. And I think as we talk about really tailored data solutions that assess better people's creditworthiness and predict what they're going to do in the future, we're talking about these kinds of super tailored, super specific solutions, just like financial planning, that actually works for low income customers on a unit basis now that there's a lot of data that we can do it with. So it's not like sitting with somebody for an hour and asking them a ton of questions. It's bringing data from a lot of different sources together to be able to accurately predict what their future life is going to look like. And then I just thought it was great that we were talking about credit throughout our conversation. And then, like 3/4 of the way through, Puneet brought in insurance. Like there might be a need for insurance at a particular period in a client's life that would make credit more possible and also more compassionate. And I started with that question of whether credit scoring can be compassionate, and which I've never thought of before this partnership that Women's World Banking had with Kaleidofin. But now looking at the success of integrating data like climate data and other data that is easily accessible, non-sensitive, cheap to use, and creates a better experience for customers, reduces over-indebtedness, reduces non-repayment rates, I can with confidence say that credit scoring actually can be more compassionate to the people that are receiving credit. Thanks to Puneet for coming. I'm so grateful to him. I just have a few calls to action. First, I mentioned that Kaleidofin is a network member of Women's World Banking. And if you are a financial institution and are interested in becoming a network member, we are looking for more network members. We have 75 financial services providers from around the world in our network. And by joining our network, you gain access to best practices, global access and networking, capacity building, and branding and global exposure opportunities, and even sometimes partnerships like the one we talked about today. So for more information, you can visit our website or contact my colleague, Dan. His email address is dt@womensworldbanking.org. We're also looking for mission-aligned partners across sub-Saharan Africa, South Asia, and Southeast Asia to help scale innovative solutions and drive real impact for women worldwide. If you're a fintech, if you're a financial services provider, if you're a policymaker in those regions interested in collaborating, you can reach out to info@womensworldbanking.org, and we can build the future of inclusive finance together. And finally, if you found today's discussion valuable, please recommend it to a colleague. And don't forget to subscribe, to rate, and to share with others. And you can leave a review on your favorite podcast platform. That really helps us to get to new listeners. Your feedback really matters to us as well, and it can help us bring you the content that resonates best with you. So please stay engaged, stay informed, and I cannot wait to see where our next episode takes us. See you next time.